Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And today's video is going to be on the relatively young company Dropbox. Now this is a subscriber request. In other words, I had a subscriber in my last article in the comment asked me what I thought about Dropbox. And I had a little time, so I thought I'd go ahead and take a stab. It's not a company that I've actually analyzed before. I know who they are. I've used their product actually. So I'm semi-familiar with the company, but I hadn't looked at it from an investment perspective. I'm primarily looking at dividend growth stocks for my personal portfolio, and I would classify this more as a pure growth stock. So what I'm going to do here is kind of go through how I would utilize the FastGraphs Fundamentals Analyzer software tool to research a company that I'm not familiar with and then decide from there whether or not I might want to consider investing in it again if it met my objective. And this would be primarily a capital accumulation, total return, growth stock type of scenario. Company pays no dividend. It's currently trading at a blended PE of just under 25. Has an earnings yield of only 4%, which is okay for a company that's growing fast. Its historical growth rate's been 51.2%. Now, this is something that I want to basically go over a little bit here because this growth rate is kind of skewed. If you look here at the bottom of the graph, you see a very high number of growth here, 22% growth rate in 19, 78% growth this year, and then forecast for 12% growth for 2021, or this year, I guess you would say, and then 19% growth for 2022. So I'm using Peter Lynch's P equals growth rate formula here because the tool is designed to try to apply a valuation reference, the orange line on the graph, if you will, that is reasonable relative to the company's prospects for growth. The blue line is the normal PE ratio. And again, this is an analytical tool. So the normal PE ratio is just under 37, 36.86. But here's the point. Just by looking at the graph, I can see the company went public in March of 2018. It was extremely overvalued at that point, in my opinion. You can see that. You know, the growth rate, this was a hype of an IPO. The company's price dropped precipitously down to $32 a share by January of 2020, and now it's recovered up here to about $22.17 here for this year. But the point is, its original price fell from 31 down to 17. It got almost cut in half, we'll call it. But now I want you to see something here. If I shorten this time frame, even though this is a young company, if I just get rid of that one big number here, now my earnings growth is 30.41%, and the PE ratio I'm using to value the stock here is 30.4. Now this gives me valuation references to analyze. It's not necessarily dictating fair value. It's attempting to reveal it. All right. But there's other ways to look at this as well. One of the things that this company's prospects have been very good about, and a lot of the analysts that I've read some research on it is they really like the free cash flow generation that this company has been generating that they believe will generate in the future. So when you look at it from a standpoint of free cash flow, you get a little more what I'll call reasonable numbers here. You see a free cash flow growth rate of about 21%, and that's pretty consistent across the board. They had negative free cash flow growth in 2019, then followed by 28% last year, and then expected to grow by 34% in 2021 and 20%. The company has, they did lay off some people, and that caused the stock price to originally drop. The company is kind of going through a transformation via COVID, et cetera. But the point is that the company is generating very strong cash flow. So from a cash flow perspective, the stock looks very, very attractively valued. So that's looking at historical data. Let's go ahead and look at forecasting data. We'll go ahead and stay with cash flow since we're here. And let's look at what is expected going forward. Now, there are only two analysts providing any forecast of free cash flow right now. And again, they're looking for 34% growth in free cash flow. And then they're looking for 20% growth next year. That's an average of 26.15. So if I use the cash flow to growth multiple, the Peter Lynch multiple, if you will, of 26, this orange line is drawn at a 26 PE ratio. If the stock were to go to that PE valuation, you can see the rates of return looking in the yellow box there in the bottom would be 50% annualized over the next couple of years, or, quite a difference. The price would go from the current price of about $22.17. And assuming they hit these earnings targets, the valuation at this multiple would put the price at $51.52 for a 54.3% annualized gain. Now, I've got one analyst looking at this stock from a standpoint of future growth, and the number is extremely high. So I'm not really going to look at this stock from a standpoint of a 40% free cash flow growth. So I checked some other sources here, and I'll just do one for you. I went to Yahoo, and look, the analysts for Yahoo expect the company to grow at about 16.8% for the next coming year. So if I go ahead and go to my custom calculator here, and I'll just go ahead and round this up and type in 17% growth, then what you'll see here is kind of a more rational valuation. That would still mean that the stock was trading on the upper end of fair value, using a price to cash flow of 17 here as my valuation reference. That would still give me a double-digit rate of return going out for the next 4 or 5 years or so. But it would suggest that the stock might be fully valued, if not slightly overvalued here as well. Now, there are analysts out there who are very, very bullish. People like Zacks are pretty sanguine about the company. A couple other analysts from some other sources are also relatively sanguine. A key bank capital analyst was really bullish on the stock. But Morningstar was a little bit negative. Now, Morningstar, if I go back to operating earnings here, Morningstar gave the company a fair value of 15. They're assessing it at a fair value of 15. Now, that would be based on essentially a forecast of operating earnings here. And, you know, if they ended up with a 20% average growth rate, and I'm using a PE ratio of 20 here, that would put the stock at a fair value of 18 as of last year, the low fair value of 14.46. So this is the type of number that Morningstar is seeing right now. So, you know, the point is, it's a little premature here. The company has generated some really strong revenue growth. Last year they did $1.66 billion in revenue. And so the companies, you can see their revenue growth has been, you know, about 28% compound average growth, which is almost 29%. So, you know, the company obviously is in a growth scenario now. Now, the real question is, what's the growth going to look like going in the future? Now, you know, I went to their website and I looked at a couple things. I'm going to kind of end by, you know, there's the 1.7. It was 1.68 actually in 2019 revenue. They have 600,000 registered users and they're operating in 180 countries. But the reality of it is that the company is having trouble converting most of those clients are free, and they're having trouble converting those into paid subscribers. That's something that some of the analysts looking at the stock are concerned about. Nevertheless, it's a very interesting company. It's kind of a modern tech stock, if you will. They've got significant competition from the likes of Google and Apple and even Amazon, etc., because, you know, they're obviously operating in the cloud, and these other firms are operating in that same market. They've got other competition. Box, another company, is a competitor. So, you know, the company has got a good product. They've got some exciting opportunities, it looks like, going forward. The valuation is reasonable as long as they can maintain their growth. So this is one you might want to take a deeper look into. I'm not saying it's a good buy here, but I'm saying it looks reasonable based on my primary focus here is on free cash flow, because I think the fact that this company is generating this much free cash flow and has this much free cash flow growth gives them a lot of options and a lot of flexibility in the future. And I do want you to notice that their free cash flow estimates have actually been increasing. You know, they were 6 months ago, for example, 2022 estimates were $1.77. They're now at $1.97. They started last year's number at $1.20. We're going to see that number pretty soon. It's now up to an estimate of consensus of $1.22, but again, not a lot of analysts. And then looking for $1.64 last year, which was only $1.41 6 months ago. So the company came up with a good earnings surprise here, their most recent earnings announcement. It's an interesting stock. It's got a lot of potential. It's one you might want to take a closer look at. I'm not going to say it's a good buy here, but if you're looking for growth and looking for capital appreciation, you might want to consider this stock. At these valuations, you know, if it were to trade at a normal multiple, again, you could have 25 to 35% annualized rates of return, but it's all capital appreciation. There's no dividend. Anyway, it's been Chuck Harville. Hope you liked the video. Give me a like. You know, don't forget to ring the bell and follow me if you're not following me already. I'd appreciate it. Thanks, everybody.